Hey everyone, welcome back, future CFA charter holders. If you've made it this far, give yourself a pat on the back. You're already ahead of most candidates out there. Now today, we're going to learn into the fast-paced, high-stakes world of hedge funds, and trust me, this topic is anything but boring. Whether you're sipping your morning coffee or zoning in after a long workday, this session is going to be worth your time. I promise to make this session as engaging and informative as possible. By the end, you'll have a solid grasp of what makes hedge funds tick and how to tackle this topic on the CFA exam. So, let's set the tone and jump into the wild, exhilarating, and sometimes downright mysterious world of hedge funds. If mutual funds are like that dependable Honda, you can always count on smooth, predictable, gets the job done. Hedge funds are the Ferrari of investments, fast, powerful, high performance, and built for those who know how to handle the curves. They're flashy, risky, kind of high risk, high reward thing, and they've got a playbook like no other. So today we're going to unpack everything about hedge funds in a way that not only makes sense, but sticks with you. By the end, you'll have a solid grasp of what makes hedge funds tick and how to tackle this topic on the CFA exam. So let's rewind a bit with a little history lesson. Originally, hedge funds were designed to hedge risk in the equity market, basically reducing portfolio ups and downs by holding both long and short positions. So back in the day, hedge funds were like the cool kids on the investment block, trying to reduce those pesky stock market ups and downs. They did this by taking both long and short positions in equities. Simple, right? Fast forward to today, hedge funds are no longer just equity focused. These bad boys now trade in real estate, bonds, currencies, and even cryptos in some cases. One fund could be going long on Swiss francs while shorting high-yield U.S. bonds and simultaneously betting on Brazilian soybean futures. So they are like quite different. One day a hedge fund might be buying stock in Tesla, betting it'll rise. The next, they could be shorting the same stock, betting it'll fall. They might even invest in oil futures or currency swaps, all at the same time. It's like a financial circus, but trust me, there's a method to the madness. Sounds like a Wall Street buffet, right? What sets hedge funds apart isn't just what they invest in, but how they invest. They thrive on complex strategies, short selling, derivatives, leverage. And yes, that means more potential for gain, but also more potential for pain. You're not just investing, you're playing chess in a thunderstorm. And while mutual funds walk a straight line under a tight set of rules, hedge funds operate with relaxed regulatory oversight. That's right, they're usually only open to accredited or institutional investors, meaning you can't just waltz in unless you got the big bucks or a solid financial network. So just remember, folks, when we think hedge funds, think financial instruments, short selling, and leverage. These can pump up your gains, but also crank up the risks. And while hedge funds are expanding like wildfire, they're flying under a regulatory radar that's a bit looser compared to other investment options. It's like they're the rebels of the investment universe. Now that you got the vibe, let's unpack the features that make hedge funds unique. I'll go through each feature with some real-world context so it really sticks. First, they're diverse. Hedge funds are investment chameleons. They don't believe in boxes. While mutual funds typically stick to the comfort zone of stocks and bonds, hedge funds can roam freely, from Tokyo real estate to lithium mines in Chile. The idea is simple. Go wherever the opportunity is. Imagine a fund shorting the yen, long on Swiss francs, holding a chunk of Bitcoin, and speculating on cocoa futures all at once. That's the kind of flexibility and boldness we're talking about. But the real issue lies in the strategies they deploy. Hedge funds love complexity. Leverage is a favorite, borrowing big to amplify returns. Of course, this cuts both ways. Just like taking out a loan to buy lottery tickets, if you win big, but if you lose, yikes. They also use derivatives, betting on price movements without owning the assets. It's like buying insurance on a house you don't own, hoping it burns down. Risky, definitely. Strategic, absolutely. Now, speaking of rewards, hedge funds are known for their famous or infamous 2 and 20 model. That means they charge a 2% management fee regardless of performance and scoop up 20% of the profits if things go well. But here's the twist. Thanks to something called a high watermark, they only earn that 20% if they beat their previous performance peak. No coasting. It keeps everyone on their toes. Now, regulation, or rather the lack of it. Hedge funds enjoy a more relaxed regulatory environment compared to mutual funds. They're private, exclusive, and agile. This freedom allows them to be more creative, but also increases the risk for investors. It's like racing a sports car with fewer speed limits. Fun, but you better know what you're doing. Now, because of their potential for both extraordinary returns and devastating losses, hedge funds are considered high risk, high reward. Remember the 2008 financial crisis? Some hedge funds got wiped out overnight, while others, like Paulson and Company, made billions shorting mortgage-backed securities. It's a high-stakes game with big winners and big losers. Now, hedge funds don't just fall into one neat category. They operate under different strategy buckets: equity strategies, event-driven approaches, relative value plays, opportunistic tactics, and even multi-manager models. Think of these like different martial arts styles. Each one has its own philosophy and risk profile, but all of them aim for alpha, returns above the market average. And for those of you wondering, can a regular investor ever get a piece of the hedge fund pie? The answer is yes, kind of. Funds of funds pool together smaller investors and allocate to multiple hedge funds. It's like getting a sampler platter at a fine dining restaurant instead of committing to one dish. A great way to get a taste without diving head first. So that's hedge fund basics and overview. Hopefully you're starting to see why these funds are such a hot topic in the investment world, and why CFA Institute makes sure you understand them for the exam. Now, here's an exam tip. The CFA exam loves to test how hedge funds differ from mutual funds, so keep an eye out for questions on fee structures, strategies, regulations, and investor eligibility. That 2 and 20 model? Expect to see it, probably more than once. And remember, the battle-ready summary you're seeing on screen isn't just a pretty slide. It's designed to help you revise smarter, not harder. You can grab the full set in the description below. We also offer Stanley Notes, formula sheets, mock exams, and more. If you want to walk into the exam truly prepared, we've got your back. All right, folks, take a breath, sip your coffee, and get ready, because up next, we're going to explore into hedge fund investment strategies. And trust me, it only gets more interesting from here. All right, now let's get into the fun part, the strategies that make hedge funds such powerful yet risky investment vehicles. We'll start with equity hedge fund strategies, which are kind of the classic play for hedge funds. Fundamental long-short is one of the most well-known strategies. Imagine this. You think company A is undervalued, say a regional bank trading below book value, and company B is overvalued, maybe a meme stock writing hype. You buy shares of company A, that's your long position, and short shares of company B. The goal here is alpha, returns that go beyond just riding the overall market. Most funds tilt long, but they can rebalance depending on market sentiment. Now we move into fundamental growth. This is where things get exciting. Picture a fund manager identifying an up-and-coming EV battery maker with revolutionary tech. They go long, betting it's the next Tesla. At the same time, they short a legacy auto parts supplier whose products are becoming obsolete. It's all about profiting from asymmetric information and deep research, spotting tomorrow's winners and today's duds. So basically, funds identify companies with strong growth potential and pile into them while shorting companies with shaky fundamentals. It's a bit like betting on the underdog while hedging against the favorite. Next up is fundamental value. This strategy is like treasure hunting. Hedge funds look for companies trading below intrinsic value, maybe a small cap industrial firm that's turning around under new management. They go long, waiting for the market to realize the company's true worth. It's patient investing, but with a sharper edge. By taking long positions in these companies, they bank on their stock prices rising as the company's fortunes improve. Much like investing in a struggling business that you believe will bounce back stronger than ever. And then we've got short biased strategies. These are the skeptics, the contrarians, the glass half empty folks. They build portfolios that are primarily short, overvalued companies, sometimes with minimal or no long exposure. Think of it like betting that overhyped IPOs will fizzle after the media buzz dies down. Of course, this is risky if the market keeps climbing, so short biased managers need excellent timing and deep conviction. Finally, market neutral strategies. These folks are the Zen monks of the hedge fund world. They balance long and short positions dollar for dollar to eliminate market exposure. If the market goes up or down, doesn't matter. They're focused on the spread between the two positions. It's like betting on who will win between Coke and Pepsi, without caring whether soda stocks rise or fall as a group. This strategy often uses leverage and can be a haven in volatile markets, but it's not bulletproof. Execution and stock selection are everything. Now, moving on to event-driven strategies, and trust me, this is where hedge funds get tactical. These funds try to make money from corporate events like mergers, bankruptcies, and restructurings. It's like being a financial first responder, rushing in when something big is about to happen and trying to make sense and profit from the chaos. Take merger arbitrage, for example. Imagine Microsoft announces it's acquiring a smaller software company. That target stock usually jumps, but not all the way to the acquisition price. It lingers a bit lower due to deal uncertainty. Hedge funds buy the target and short the acquirer, betting the deal will close and that price gap will close. But watch out, if the merger fails, they're exposed. It's a delicate play. Now let's get gritty with distressed or restructuring strategies. These funds invest in companies going through serious trouble. Think bankruptcy or restructuring. Maybe they buy senior debt at 40 cents on the dollar, expecting the company to reorganize and pay back 80 cents or even par. Or maybe they buy what's called a fulcrum security, which gets converted into equity post-bankruptcy. It's a high-risk, high-reward game, like buying a beat-up house in a good neighborhood, renovating it, and flipping it for profit. Now, special situations take this a step further. These funds dive into events like asset spin-offs, capital distributions, or big strategic shifts. If a company is selling a major division or announcing a big buyback, that's a signal for event-driven funds to dig in. These scenarios often lead to mispricings or temporary inefficiencies, prime hunting ground for hedge funds. Last in the event-driven category, we've got the activists. These are the hedge funds that don't just invest, they agitate. They buy a meaningful chunk of a company and then push for change. Think Carl Icahn, Bill Ackman, big names. They might demand the board spin off a division, change management, or restructure the business to unlock value. Unlike private equity that works quietly behind closed doors, activists do it in public and shake things up. Now, let's take a breather here because we've already covered a ton and these strategies are complex. But keep this in mind. CFA Institute loves to test your understanding of the mechanics and motivations behind these strategies. You're not just memorizing names. You need to grasp what the fund is doing, why they're doing it, and what the risk-return profile looks like. So folks, expect questions where you're asked to identify the most appropriate strategy based on market conditions or investor goals. Now moving over to relative value strategies. These are all about sniffing out mispricings between related securities. You're not betting on the market going up or down. You're betting that two prices that should be closer will eventually converge. One of the most well-known is convertible bond arbitrage. This one's like juggling a bond and a stock at the same time. You buy the convertible bond, which can turn into stock, and short the stock itself. Why? Because the bond has an embedded call option. You're trying to lock in profit from that mispricing while neutralizing the market risk. This strategy is often described as market neutral. But don't let that fool you. It still comes with credit risk, interest rate risk, and sometimes a whole lot of complexity. The exam loves to test the difference between this and equity long-short, so keep that clear. Then we've got fixed income general strategies. These are pretty straightforward. They involve finding over or undervalued bonds and betting on the spreads converging. You might compare two different issuers or even two different bonds from the same company, or maybe you're taking a position between corporate and government bonds. It's about spotting relationships that have temporarily drifted apart and expecting them to come back in line. Think bond pairs that usually move together, but for some reason one's now mispriced. That's where these funds pounce. Next in line is fixed income, asset-backed, mortgage-backed, and high yield. This strategy targets mispricing in structured debt products. Say a mortgage-backed security is offering a higher yield than similar bonds, but you believe it's mispriced due to market panic. Hedge funds swoop in, snap it up, and wait for yields to normalize. They also look for pockets of opportunity in junk bonds, where yield compensates for risk. These strategies often target coupon payments and take advantage of spreads, but they come with credit risk baked in. And finally, within this category, we've got the multi-strategy funds. These are like the Swiss Army knives of hedge funds. They'll jump from one relative value trade to another across asset classes. If convertible arbitrage dries up, they might shift into fixed income plays. It's about flexibility and agility. These funds are popular in uncertain markets where sticking to one playbook just isn't enough. Now let's wrap up section 2 with opportunistic strategies, the wild cards of the hedge fund universe. These don't fall neatly into a single box, but instead react to global trends, macroeconomic data, and sometimes just gut instinct. Macro strategies are the rock stars here. Think of George Soros breaking the Bank of England. Macro hedge funds study global interest rate policies, GDP growth, inflation, you name it. If they see a trend, they ride it with massive positions in currencies, commodities, and bonds. These strategies love volatility. They thrive on big swings. But when central banks intervene or markets calm down, these trades can go south fast. Last but not least, managed futures, also known as CTAs. These funds actively invest in commodity and financial futures using a mix of fundamental and technical analysis. They love a trending market, whether up or down. One key benefit, they can go short in a declining market and still make money. But there's a catch. In sideways, choppy markets, what we call mean reverting environments, they can take a beating. The exam loves to throw a question your way on whether CTAs add diversification. Yes, they can, but only when trends persist. So if we zoom out now, hedge funds aren't just a single strategy, they're a toolbox of sophisticated approaches to generate alpha, manage risk, and exploit inefficiencies. And as a CFA Level 1 candidate, knowing how these strategies work and when they work matters more than just memorizing names. Now, let's finish this section by exploring characteristics, benefits, and limitations of hedge funds and how all these fancy strategies translate into real-world investor challenges. Though we have generally talked about this stuff earlier, but let's see what we have here. All right, now that we've taken a whirlwind tour through hedge fund strategies, it's time to zoom out and look at what truly sets hedge funds apart from other investment vehicles. Think of this part as the personality profile of hedge funds. If mutual funds are the well-behaved honor students of the finance world, hedge funds are the risk-taking entrepreneurs, breaking some rules, bending others, and chasing those big asymmetric payoffs. So, what makes hedge funds so different? First off, let's talk about the legal playground. Hedge funds operate with fewer legal and regulatory constraints than your typical mutual fund. That's right, they get to play with tools most others can't touch. This freedom means they can go short, use derivatives, or load up on leverage without constantly looking over their shoulder for regulatory slapdowns. On the exam, don't be surprised if they contrast hedge funds with mutual funds here. This shows up a lot. Next, flexibility is the name of the game. Hedge funds aren't boxed in. They can short stocks, go long commodities, trade swaps, or even buy distressed real estate. If there's an edge to be found, they'll chase it. This flexibility is built right into their mandates, which are often written broadly so managers can pivot quickly when markets shift. And with all that freedom comes a broader investment universe. Hedge funds don't just dabble in the S&P 500 or stick to investment-grade bonds. They dive into private credit, exotic derivatives, and even cryptocurrencies depending on the fund. Their strategies are often aggressive and concentrated. Unlike traditional funds that spread across dozens of holdings, a hedge fund might take massive positions in just a few names. It's like betting big on a few strong hands at the poker table instead of trying to win slowly with small chips. Of course, there's a trade-off. These aggressive styles expose hedge funds to credit risk, market volatility, and liquidity crunches. You could be holding a position that looks great on paper, but if markets seize up and nobody's buying, you're stuck. No exit, no liquidity, and maybe no sleep. And let's not forget leverage. Hedge funds love it. But here's the thing, leverage amplifies everything. Get it right, and you look like a genius. Get it wrong, and you're the cautionary tale in someone's risk management textbook. Leverage is used to juice up returns, but it also dials up the danger. Think Archegos Capital. They flew too close to the sun using leverage, and well, they got burned. Another characteristic you'll hear about is liquidity constraints. Hedge funds often require investors to commit their capital for extended periods, what we call lockups. And even when redemptions are allowed, there might be gates, limits on how much money investors can pull out at once. It's like checking into a 5-star hotel where they won't let you leave whenever you want. And yes, hedge funds don't come cheap. Their fee structures are notoriously high, usually built around that 2 and 20 model, 2% management fee, 20% of profits. And even that's just the base. Add in performance hurdles like high water marks, and you've got a complex fee setup that rewards managers when they outperform, but doesn't let them ride coattails after a loss. For the exam, remember that these fees are both a feature and a challenge. They align interests but can also erode net returns if performance lags. Now that we've nailed down what sets hedge funds apart, let's switch focus to the benefits and challenges that come along with these strategies. From a strategy perspective, hedge funds are versatile. They can invest in publicly traded stocks and bonds using traditional analysis, but with their own aggressive spin. They often combine long and short positions using leverage, which gives them a unique risk-return profile. And unlike mutual funds, hedge funds are notoriously opaque. Less transparency, less reporting, and fewer regulatory disclosures. That's both a blessing and a curse. So what's the upside? Hedge funds can go where others can't. They can invest in illiquid assets and hold them for longer periods, sometimes riding out short-term volatility in ways mutual funds simply can't. Their strategies often aim to generate alpha, returns beyond the market, and provide uncorrelated performance, which is a fancy way of saying they don't always move in sync with the rest of your portfolio. That's gold for diversification. Some hedge funds even have strategies that act as built-in risk management tools. They might hedge against market downturns or use derivatives to limit downside. This kind of strategic flexibility is hard to find elsewhere. But it's not all sunshine. There are plenty of challenges too. For starters, hedge funds often share limited information with investors. You might not know exactly what positions they hold or how exposed you really are until it's too late. Their strategies are also complex, which makes due diligence tricky even for sophisticated investors. And then there's the issue of redemption restrictions. If markets are tanking and you want your money back, you might be stuck behind a gate or within a lockup period. That can be terrifying, especially if you need the cash. Hedge funds also come with elevated risk due to their use of leverage, concentration, and derivatives. And because they operate with less oversight, there's always the lingering risk of fraud, which history has shown isn't just theoretical. Hello, Bernie Madoff. So, where does that leave us? Well, hedge funds are like the sports cars of the investment world. Powerful, fast, and exciting, but they're not for everyone. You need to know how to handle the machine. For CFA candidates, understanding the nuances of hedge funds, how they work, why they differ from traditional investments, and what risks they carry is critical. These concepts are fair game for the exam, especially when comparing fund types or analyzing investor suitability. And hey, before we wrap up, if you found the battle-ready summary slides on screen helpful during this lecture, you can grab the full set along with our Stanley Notes, question bank, formula sheets, and full-length mock exams over at FinQuiz.com. Trust me, it's a game changer during revision season. All right, take a deep breath, shake off the hedge fund fog, and when you're ready, we'll roll into Section 3. Okay, folks, let's keep the momentum going. Hedge fund investment forms. Now, this one's less about what hedge funds do and more about how they're structured and how investors get in on the action. Picture this. Hedge funds aren't your average investment vehicle. These are typically set up as private partnerships where you've got two key players, the general partner, who's the manager running the fund, and the limited partners, aka the investors, putting up the money. The beauty of this setup is that it's incredibly flexible, especially when it comes to tax optimization. Offshore or onshore, this structure allows funds to cater to specific investor groups and comply with different regulations. Now, let's talk money. Hedge fund managers get paid in two ways: a management fee, usually a percentage of assets under management, and a performance bonus based on how well the fund performs. Investors, meanwhile, buy into the fund and receive whatever returns are left after those fees are taken out. It's like ordering a pizza. You get your slice, but the manager definitely takes a hefty cut first. Now, here is the issue. Hedge funds aren't exactly open books. They've got transparency issues. Sure, legal documents outline the fund's structure and operations, but compared to mutual funds, it's a bit like peeking through frosted glass. And even though hedge funds are technically perpetual, meaning they're not set to expire, most of them wrap things up when the strategy closes or the manager calls it a day. All right, now let's see how investors can access these funds, starting with direct hedge fund investment forms. One popular method is the master feeder structure. It sounds complicated, but the idea is pretty elegant. You've got multiple feeder funds, some based offshore, some onshore, all channeling their capital into one master fund. This master fund then handles the investing. Why go through all this trouble? Mainly for tax efficiency and to attract different types of investors across jurisdictions. Big institutions love this model because it lets them pool capital efficiently. Another direct route is the single investor fund, also known as a separately managed account, SMA. Think of it like having your own private chef instead of eating at a buffet. With an SMA, the fund is tailored specifically to one investor's mandate, offering more control, better transparency, and even potentially lower fees. But there's a trade-off. Operational complexity goes up, and the manager's incentive might shrink if their own money isn't in the game, unless, of course, you throw in some performance-based rewards to keep them motivated. Now, speaking of fees, here comes that classic CFA favorite, the 2 and 20 model. That's 2% of assets as a management fee and 20% of profits as performance fee, as we have discussed earlier. But times are changing. Investor pressure has led to newer models with reduced fees or fees tied to alpha generation, meaning the manager only gets paid when they actually beat the market, not just for showing up. There's also something called side letters. These are private agreements between the fund manager and a specific investor. They don't change the core documents for everyone, but they might give that investor special terms like early liquidity, reduced fees, or enhanced reporting. It's like getting VIP access at a club while everyone else waits in line. Now let's talk about indirect hedge fund investment forms. These are for investors who want hedge fund exposure but don't want or can't afford to dive in directly. First up, the fund of hedge funds, FOFs. These invest in a portfolio of different hedge funds offering instant diversification across strategies and regions. It's like buying a mutual fund of mutual funds, but for hedge funds. The pros? Lower investment minimums, shorter lockups, and better liquidity. Plus, the FOF managers do the heavy lifting, due diligence, manager selection, monitoring performance, negotiating terms. The cons? Double fees. Yep, you pay fees at the fund of funds level and the underlying hedge fund level. So your net return might take a hit. Still, many investors choose FOFs because they provide access to hedge funds that are otherwise closed to new investors. Next, we've got hedge fund replication ETFs. These are a newer, more accessible way to mimic hedge fund strategies using either passive indexing or active quant techniques. Imagine tracking a basket of hedge funds or trying to mimic their returns using models. These ETFs offer higher liquidity, more transparency, and lower fees, but there's a cost. Performance can lag. Since they're public, they can't use leverage as freely, and they're subject to more regulations. Also, you miss out on some of the alpha generating strategies that rely on secrecy, speed, or private deal access. And finally, let's talk about liquidity spectrum, This shows up in the exam and real life. Hedge funds exist on a sliding scale from least to most liquid. Now, this section is something both exam relevant and real world critical. Think of this as a sliding scale of how fast you can get your money out. Because in hedge fund world, not everything is as simple as clicking sell. At the sticky end of the spectrum, we've got limited partnerships. These are the least liquid. You commit your money and it's like Hotel California. You can check out anytime you like, but you can't leave, at least not for a while. Lockup periods and gates can keep your capital tied up for months or longer. One step up, we've got SMAs or separately managed accounts. These offer more flexibility because they're tailored to a single investor, so terms can be negotiated and liquidity tends to be better than partnerships. Moving along, closed-end funds come next. These don't offer daily liquidity, but they do have scheduled redemption windows, so you're not stuck forever, just not instantly free. Mutual funds are way more flexible. You can usually redeem your shares at the end of any trading day. No drama, no delay. And then at the top of the liquidity food chain, we've got ETFs, the rock stars of liquidity. You can buy or sell them like a stock in real time during market hours. Fast, easy, and perfect for the impatient investor. So if you're ever asked to rank investment forms by liquidity in the exam, just remember, LPs crawl, ETFs fly. So when thinking about investment forms, always consider how much control does the investor want, how much liquidity do they need, and how comfortable are they with less transparency. And remember, this stuff is prime exam territory. CFA Institute loves to ask how hedge funds are structured, how investors gain access, and what the trade-offs are between direct and indirect investments. All right, breathe out. That wraps up section 3. Let's keep the pace steady and roll into the next one. All right, CFA Level 1 crew, let's dig into the real heartbeat of hedge funds. Risk, return, and diversification. Now, unlike traditional portfolios that chase market exposure, or in CFA lingo, beta, hedge funds are out here trying to pull off something cooler. Alpha. That's the extra juice, the return above and beyond what the market's giving. And believe me, managers wear that alpha badge like a medal of honor. But how exactly do they make money? Think of hedge fund returns like a 3-layer cake. The bottom layer is market beta. This is your basic exposure to the market, like tracking the S&P 500. On top of that, you have strategy beta, which is the performance tied to the specific game plan. Maybe it's long short equity or merger arbitrage or global macro. And finally, the cherry on top, alpha. That's where the manager tries to outsmart the market with active bets. Now here's the thing, measuring performance isn't as easy as comparing mutual fund returns. Why? Because hedge funds operate in a world full of both systematic risks, like market downturns, and idiosyncratic risks, like poor management decisions in one single position. So benchmarking gets murky. Add to that the fact that hedge funds don't always report performance publicly, and you've got a recipe for confusion. Let's say you're looking at a hedge fund index online. You might think, wow, these funds are crushing it. But hold on, that performance might be biased. How? Well, there's selection bias. Maybe only the good performing funds are getting picked. Then there's survivorship bias. Underperformers vanish from the data like ghosts. Oh, and don't forget backfill bias. When new funds join the index and retroactively add their stellar past returns, it inflates the numbers. Finally, there's reporting bias. Some funds only report when things look good. Classic cherry picking. Even the way these indexes are calculated can skew things. Many don't weight returns by the size of assets under management. So a $50 million fund and a $5 billion fund might be treated the same. That's like comparing a local diner with McDonald's and saying they both represent the restaurant industry equally. Now, what about actual risk and return? Historically, hedge funds have delivered decent returns, often beating traditional stock and bond portfolios since the early 90s, but only after adjusting for risk. And yes, they've done this with similar volatility to bonds, but those results are very benchmark dependent. The index you choose, whether it includes fees or not, makes a big difference. Let's talk business for a sec. Consider a fund manager running a short bias strategy during a year like 2008, when the market was crashing, short sellers had a field day. That manager may have looked like a genius, but the same strategy in a strong bull market like 2021, oof, completely different story. That's why CFA exams love to test the risk-return profiles of different hedge fund styles. Remember, it's not one size fits all. Now, the diversification benefits, because this is often the main reason investors bother with hedge funds, especially institutional ones. Back in the day, hedge funds were mostly market neutral. They weren't trying to beat the market just to make steady, positive returns no matter what the market did. But over time, the toolkit expanded. Event-driven, macro, relative value, you name it. The whole point was to reduce exposure to stock market swings and still come out ahead. And this strategy really shone during major market meltdowns. Think about the 2000 dot-com bust or the 2008 financial crisis. While traditional portfolios were bleeding red, some hedge fund strategies managed to stay in the green, or at least lose less. That's when institutional investors really started taking hedge funds seriously. After 2008, we saw a shift. Investors stopped chasing absolute performance and started focusing on risk-adjusted returns. And hedge funds that could show a better Sharpe ratio started pulling in capital like magnets. Now, adding hedge funds to a traditional portfolio, say your 60-40 stock bond mix, can actually lower the portfolio's standard deviation and improve the overall Sharpe ratio. In plain English, you could end up with better returns for each unit of risk you take, and that's a sweet deal, especially in today's unpredictable markets. But not all hedge funds are created equal, and diversification benefits can vary widely. That's why due diligence is critical. Investors need to look under the hood, not just chase the fancy strategy names or past returns. What worked in 2010 may flop in 2025. All right, let's bring this home. If there's one thing to remember for the exam and for life, it's this. Hedge funds are like gourmet cuisine. Done right, they're rich, complex, and deliver something special. Done wrong, they'll burn a hole in your wallet. So whether you're analyzing alpha, decoding index bias, or assessing diversification benefits, just know that hedge funds require sharper tools and a more skeptical eye. And if the exam throws you a question on this section, expect it to test your understanding of alpha versus beta, biases in performance data, and why and how hedge funds might improve a portfolio's risk-return profile. So yeah, hedge funds, not your average mutual fund, but definitely test-worthy, career-relevant, and worth mastering. If your brain's spinning a little, hey, that's normal. Hedge funds aren't light reading, but remember this. In the world of investing, they're like the high wire act, big risk, big skill, potentially big reward. On the exam, CFA Institute loves to test whether you can separate the hype from the facts. So keep your focus on concepts like alpha versus beta, return biases, various hedge fund investment strategies, and portfolio diversification benefits. All right, take a deep breath, do some practice questions to cement what you have covered here, and let's get ready to tackle the next topic. You've got this. See you in the next one.